Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, mutual funds are the vehicle to wealth. But selecting one fund can be a really daunting task. And that's exactly what we are going to focus on today's show. We will provide you with a comprehensive checklist of all that you need to consider, all that you need to evaluate before picking that mutual fund and looking at a fund that perhaps is going to match your needs and goals. And then, more importantly, evaluation. Is that fund still on track to meeting your objectives? So this is an important one. You must listen in carefully. And my guest today, who is going to help us in this classroom, is Mihir Vora, Chief Investment Officer at Trust Mutual Fund. Mihir, thank you very much. And it's great to have you. I think this is the first time we're having you on Let's Talk Money. So welcome to the show.
Thank you so much. Always a pleasure.
So, this is something that we talk about a lot of times when we're doing our personal finance conversations. And I must admit that for most viewers, even the queries that we get, it all boils down to, okay, tell me which is going to be the best fund for the next 1 year. And when a viewer or an investor asks about the best fund, typically it's all about performance. But hey, is that really such a bad thing? It is about performance at the end of the day, right?
Ultimately, yes. But one must also realize that you are in charge of the performance of your overall portfolio. So while you might select a fund based on the recent performance, you as an investor are supposed to take a view for the longer term because you have some longer term objectives in mind. Right now, for the last 5-7 years, the stock markets have become so glamorized, and plus this is the first time probably that we have so much social media, so much buzz, apart from the TV channels, etc.
Yeah.
So there is a lot of noise, and it's become more of a glamour activity rather than a, I say, a cool planned activity. So I think it's time that somebody, steps back and takes a longer term view and plan it out.
I think and that's especially important now, right? Because we see this market hitting all-time highs on a daily basis, but you and I have known, even I've been around covering this business for such a long time, that's not typically how cycles work. There are periods of underperformance, and that's where you need to know that you've done the right thing with your portfolio. So let's start with the basics. I mean, where should one begin? If you want to have a very holistic approach to creating a mutual fund portfolio, then what's the starting point?
So as I said, there is so much noise and there's so much glamour these days in stock trading and investments that we tend to forget the bigger picture. The bigger picture is that, yes, investing is an art and a science. It's a combination of both. Yeah. But your life goal planning, your financial goal planning is more of a science, I would say. So your goal planning, your financial, achievements that you want to, attain by a certain age, by a certain milestone, that are very scientific. Because the one thing that you know is yourself, right? And you should know yourself. Yeah. What are your aspirations? Yeah. What are your lifestyle ambitions? What is your age? What is your risk profile? What is your social background? Based on all this, you will know what you need to do in life. What are your life events? For example, as a 25-year-old, if you want to own a house by 35 or 40 years, what are the returns that you need to? What are the savings that you need to do? What are the returns that you need to generate? If you are a 40-year-old, is your kids' education your immediate concern? So education, marriage, house, these are all big financial goals that we need to plan for, and this can be done in a very scientific fashion because you know your age and your profile.
Oh, absolutely. So you need to start by defining some of your sort of more quantifiable aspects of where you want to get in life.
Absolutely.
By the way, I must tell our viewers that while I was looking at the data points that you had sent us before the show, there is a 3D approach, and I want you to elaborate on it. So what are the 3Ds, viewers, that Mihir is talking about? He's saying define, decide, and then do the due diligence. So why don't you expand on these 3Ds?
Certainly. So as I said, first of all, the description of your profile and your ambitions and your life goals is what would form part of definition. So you look at your age, you look at your liability profile, and plan out. 1 year down the line, do you need some money? Maybe you want to go for a vacation. So that's a shorter term goal. 5 years down the line, do you want to start buying a house? So that's the second goal. 15 years down the line, 20 years down the line, are you planning to have kids, and for their education, do you need money? Yeah. 25 years down the line, maybe you need money for their wedding. So, and similarly, if you're a 40-year-old, probably you need to start planning for retirement.
True,
for the next 20 years. So look at your lifestyle ambition, look at your goals. Because again, there are certain people who are very conservative. They don't have a flashy lifestyle. So their current consumption is not very high. But certain people have societal or individual requirements, they want to consume more, then probably they need to generate more returns on the portfolio.
But, let me ask you one thing, that today a lot of your investors are not even millennials, probably Gen Z, right? And here the classic definitions of goal-based planning about, this certain age marriage and then kids and all of that, it's very dynamic. So I don't know if your newer investors can actually plan for the next 20, 30 years. So then how should they approach goal-based investing?
See, the point is, you should be aware that these are factors. Okay. A lot of us just run through life enjoying watching movies and Netflix and all that without even stepping back and thinking, what am I going to do for the next 5 or 10 years, So things are structured if you want them to be. Yeah. Otherwise, you can just, go along and then after 10, 15 years, suddenly there are people who don't have any savings at 40, 45, and suppose you lose your job. Yeah. What do you do? Yeah. Yeah. So those are the things that one needs to step back and think about.
You need to plan. Okay, so then...
that was on the definition part. Then, of course, once you have the goals defined, then you decide what your portfolio allocation can look like. And frankly, now there are many tools available on the internet, but a good financial advisor can, run you through the process. I personally believe it's still a high-touch, issue. So you should find a good financial advisor, even if your corpus is small, because financial advisors will also take a longer-term view on you, because you are also going to grow in your career. So they want to develop a new, a long-term relationship. So define once you know your asset liability profile, your own self, then you decide on the portfolio. That's the second D.
Okay.
So what should be the asset mix? Yeah. And then a good portfolio, if you're planning for the next 15, 20, 30 years, it'll be changing dynamically. So at the early part, you will have more risky assets in the portfolio. At the later stage of life, you'll start trimming and rebalancing your portfolio towards safer assets. So all that can be planned out in advance, and at least you have some map in which direction you want to go.
And how you want to sort of go about it.
And the third is, of course, the diligence part. Yeah. As I said, once you set out and you've done your initial asset calculation, periodically, maybe 6 monthly, maybe yearly, just again take a look whether things are going as per plan or there's some dynamic change that you need to do. And as I said, as you mature, your asset allocation itself will change. So that itself, the plan itself might require some diligence and reallocation of assets.
Fair point. So those are the 3 Ds that should define our sort of investment mindset. I want to take up a question here because I think it's very much in sync with what you're saying. And this is actually coming in from one of our young viewers as well. This is Nidhi. I think we have Nidhi with us on the phone line. Yeah, Nidhi, hi. Welcome to Let's Talk Money. Thank you so much for joining in. Tell us, what's your query?
Hi, my name is Nidhi. I'm a 26-year-old working professional. I want to build enough corpus to help me buy a house in 10 years. How do I select a good mid to high risk mutual fund to invest my money in? I can invest up to 10,000 rupees a month.
There you go, Mihir. So we've discussed the theory. It's time to put it to practice.
Oh, absolutely.
So how should someone like Nidhi, looking at a 10-year horizon and buying a house, how should they start with a mutual fund portfolio?
Certainly. So first of all, congratulations, Nidhi. I think you've achieved the first step towards financial independence, which is at least you're aware that you need to start investing now to buy a house after 10 years. So that's great. And the good thing is that since you are starting early, you can take more risks. So a significant, I mean, assuming of course you don't have any immediate liabilities, etc. You can start with a equity allocation which is much higher than what say a 40-year-old person would be entitled to, so to say. And equity over the long term we have seen does give good compounded returns over a long period of time. So my guess is that you should start with a plain vanilla diversified fund or a flexi cap kind of a mandate. And then of course as you study the market, do some more reading and see if there are some more thematic funds or small and mid cap funds which you want to add to maybe spice up the returns a bit. But the core should be either a multi cap fund or a flexi cap fund to start with. And as you said, 10,000 rupees is a good amount to start with. But I'm sure as you grow in your career, your income will also increase. So that 10,000 rupees does not have to be cast in stone. Yeah. As you start saving more, even that amount you should keep raising and of course build a good corpus over the next 10 years. So all the best to you.
Okay, fantastic, Nidhi. Hopefully that will help you and good luck with those plans. Now, I want to take up the third part, the third D, which is the due diligence and the evaluation, Mihir, because I think here a lot of investors simply look at returns. They'll look at the benchmark index return, they'll look at their fund, and then they'll wonder if it's good or bad. So help us out in both cases. When you're picking a brand new fund, then what's the checklist? What are the factors to consider? Maybe even costs, right? And when you're evaluating a fund that you're already invested in, then how do you decide whether to stay with it? Or, the temptation can always be there. That a peer set, a category, or a similar category fund maybe did 3% more or 4% more. So, but how do you decide whether it's time to switch or just stay the course?
Absolutely. So first of all, as you rightly said, look at the benchmark. Not all funds are the same because fortunately or unfortunately, we have so much information available right now, and you can sort and screen any kind of data freely on the internet. So typically what investors tend to do is they tend to go on a website and sort on, say, 1-year returns or 6-month return or 5-year returns and see which fund is doing very well.
Absolutely.
But that's only half the picture.
Yeah.
The returns don't adjust for risk, right? Because it is possible that you're in the top 10 funds that you see, there are some large cap funds, there are some flexi cap funds, there are some small cap funds, and there may be absolute, out of the ballpark, thematic funds which have done very well, right? But the risk in a thematic fund is much different from the risk in a small cap fund, and it's much different from the risk in a flexi cap fund.
Yeah.
So first of all, know your benchmark. Then try to evaluate the performance. Okay. And of course, once you are doing the due diligence, what matters is the philosophy of the fund house. Who are the promoters? What's the corporate governance? Are the fund managers experienced enough? Have they seen cycles? And more importantly, do they run their products true to label?
Okay.
Because there have been many instances where you suddenly see a consumer fund with a energy company in that, so of course that can work in the short term, but then you're not getting what you bought.
Right.
So is the fund run in a true to label? So what are the processes? What is the philosophy? What is the culture of the fund house? That's most important, because ultimately we can put anything on paper, but it's a few people in the fund house that ultimately call the shots. So you need to be aware of the promoters and the fund managers and the consistency of the philosophy that they follow.
Okay, well said, and I think that's great advice to keep in mind while we are picking our funds. We do have to take a break on that note. So now we've discussed why it's important to set goals and how we start evaluating the basics of evaluating a mutual fund. On the other side, we discuss why it's also important to learn more about market cycles. As investors, we need to get more involved and evolved with our investing philosophy. So we'll discuss this on the other side.
Let's talk money.
Welcome back. You're watching Let's Talk Money, and this week we're in conversation with Mihir Vora, and we're discussing how to go about selecting mutual funds. This is a lot harder than perhaps you would consider at first glance. It's not about just getting the best tip about the best fund. You want to be more involved with the whole process, so awareness and sort of getting down into the details, that's what it is all about. Now, Mihir, before we start talking about learning more about the market and cycles, etc., another concept, like when we talk about stocks, there are certain ratios. You need to know the price to equity, a price to earnings ratio, or the ROE, etc. When we are discussing mutual funds, apart from price performance, are there any other parameters or ratios that one needs to keep in mind?
Absolutely. So as we just discussed, the first thing to understand is that returns should not be looked at on a standalone basis.
Sure.
You need to adjust for risk. And there are many ratios available in the market, and again, websites have it, etc. But they look very complicated. But actually, they are not very complicated.
Okay.
Essentially, what ratios do is look at the returns. For example, in the Sharpe ratio, the numerator is the excess return of the mutual fund or the portfolio compared to the risk-free rate, which is typically the government bond yield. Okay. So risk-free rate, that's the excess return. And then the denominator is the volatility of that excess return. Okay. So the excess return, is it consistent or very volatile?
Okay.
So if the excess return of the portfolio over the risk-free rate is very high, then it drags down the Sharpe ratio.
Got it. So because you're getting the higher return, with so much volatility.
With so much volatility,
that it could really be, it could make your heartbeat fluctuate.
Absolutely. Similarly, in the information ratio.
So just to complete the Sharpe ratio point, that means the higher the Sharpe ratio, the better the fund, right?
Absolutely.
Simple.
Because either your returns are much better or your volatility is much lower.
Absolutely.
So you are basically, in all these cases, you are adjusting for risk.
Sure.
Risk always comes in the denominator and the excess return or the returns come in the numerator.
Got it.
Similarly, in the information ratio, instead of the risk-free rate, you calculate the outperformance or underperformance of the portfolio versus the benchmark. And then the numerator and the denominator is the volatility or variability of the excess return versus the benchmark.
Okay.
So in the first case, it was the risk-free rate.
Yeah.
In the second case, you are comparing versus the benchmark. In both the cases, you are calculating excess returns in the numerator
versus
and the volatility in the denominator.
Got it. So these are some more tools to, understand if a fund is giving you better returns. Is it worth it? I mean, is it coming with less volatility? Is it still consistent or not?
Correct. And then there's one more layer to it.
Okay.
When you're talking about the benchmark, you also must understand what the benchmark is. So benchmark itself may be more volatile or less volatile.
Sure.
So if it's a FMCG fund, the benchmark itself will be less volatile.
It will be the Nifty or the BSE sector index, the FMCG index.
Exactly.
Yeah.
Or if it's say a pharmaceutical, if it's a infrastructure fund or a manufacturing or capital goods fund, the benchmark itself will be more volatile.
Sure.
So then your excess returns will be versus a more volatile or a less volatile benchmark.
Sure. So some factors to keep in mind. Also, while we are discussing, concepts around this, I want you to demystify the concept of NAV itself, because there are lots of myths around it, right? Is a high NAV fund good, a low NAV fund good? So this is myth buster time then on NAV.
Absolutely. So NAV is nothing but, the assets of the fund divided by the units, number of units that have been issued. So it doesn't really matter because every day you're issuing more units or less units depending on redemptions, inflow, outflow. So the denominator, of course, is the number of units that the shareholders own, and the portfolio is the is the numerator. So the denominator is the number of units. So it doesn't matter whether you start at 10 rupees or 100 rupees.
Correct.
For example, our FlexiCap fund that we launched a couple of months ago is up by 10% on a 10 rupee NAV, because the markets are also plus minus 10% in that same time frame. At the same time, I'm sure there are funds which had a 100 rupee NAV at that point in time. So my 10 is up to 11, and the 100 rupee NAV fund would be up to 110. So ultimately the returns are similar, but on a different base.
It's like the same concept.
High NAV or low NAV in absolute terms doesn't matter. It doesn't matter.
It's like the same concept. The price of the stock per se doesn't matter whether a 100 rupee stock goes to 120 or whether a 200 rupee stock, rises by the same percentage. Exactly. So got that. So important concepts. Hope our viewers are listening in carefully. Now, Mihir, to come to the aspect of knowing more about the market as we want to evolve as investors. Cycles, styles, and it's getting more and more complex, right? Because you have this momentum style and the quality style and low volatility, etc., etc. Then you have different sectors. You have funds coming on infrastructure, like you said, on FMCG, on pharma. So it's getting really complicated for us investors out here. How do we navigate this?
No, absolutely. There are two things that we already discussed. In the first part, which was defining your goals, the first thing was know yourself, right? Second was know the fund house or the fund manager, right? And in this, you actually need to know the characteristics of the underlying asset classes.
Sure.
So we've seen that, no style or sector performs consistently over each period of time. So if you even look at a longer term of 1 year kind of returns, you've seen, for example, from 2012-13 to say 2020, private banks did very well. Then low volatility stocks, high quality stocks did very well. But for the last 4-5 years, we actually see momentum and high beta stocks do very well. Metals have certainly done well. For almost 8 years, IT was a big underperformer, right? From 2012-13 to almost 18-19-20. But in the last 3 years, IT did very well. So no one value, momentum, quality, low volatility. These are all different styles and strategies which can work at different points in time. So either you as an investor take up the onus on yourself to decide, try to figure out which styles you're going to buy, or you leave it to the fund manager.
Sure.
So as I said, by default, you should go for a diversified fund. That should always be, whether it's a large cap fund or a flexi cap fund or a multi cap fund, that has to be the core holding in your portfolio. And then the extra kicker based on your financial advisor or knowledge, you can play. That's where the thematic funds come in. Suppose you are really bullish on the manufacturing theme for the next 5 years, you might want to put some part of your portfolio, but not a big chunk of your portfolio in that theme. But then that portion you will have to actively monitor and manage. It can't be a buy and hold.
So, I actually have a quick question on thematics, and maybe we can quickly take this up. Last few minutes left on the show. This is from Shabeen. She is a viewer, and she's, asking, how can I select a sectoral mutual fund if I want to weave it in my long-term investment portfolio? And can I actually look forward to more appreciation if I add thematics? I think it's a very relevant question.
Absolutely.
So what should the approach be?
So, see, that's what I'm saying. When you are choosing a diversified fund, flexi cap or large cap or a multi-cap fund, the decision to go for a particular theme or a sector lies with the fund manager. But when you are selecting a thematic fund, the decision to go in that theme or that sector is yours. So, if you want to choose a sector fund, you have to then yourself do a good analysis of the sector, take a view on that sector, and then actively monitor it. You can't just buy and hold it.
Yeah.
Because the decision to go for that theme or that sector is yours.
Okay. Mihir, it's been a great classroom, lots of concepts, but we now want to recap. And also maybe, the stuff to do and also the stuff not to do, the mistakes to avoid. So in a nutshell, if you could sum it up for us.
See, as I said, you need to have a plan.
Yeah.
Follow up on the plan and monitor the plan on a reevaluate on a periodic basis. And look and just focus on the basics. Don't over-concentrate in one fund or one stock or one fund house, diversified across a few funds, but then don't over-diversify also. So take a few funds, monitor them closely, and once a year, just see whether things are going as planned and rebalance it. So that's one. Second is, do not ignore other asset classes. For example, debt fund is a significant category that can also add stability and a regular income to your portfolio. Sometimes people mistake mutual funds as only equity funds.
Yeah.
But debt fund is
End
also an
up
asset
thinking that way, just stock market, stock
So
market.
debt fund is another asset class that one should look at. So those are the basics one should take care of while building the portfolio.
So before I end, because Mihir is the big boss at Trust Mutual Fund, you tell us personally what funds do you like to be in, and for your personal investing style, what kind of funds do you have your money in?
So my big money is of course in my own fund, and we only have one fund at this point in time, which is a flexi cap fund, and a little bit in the other fund because anyway skin in the game demands that we put money into the other income funds also. So right now most of my mutual fund investments are in the flexi cap category, of course.
Okay, all right, Mihir, great conversation. Thank you so much for joining in and busting some of those myths and also giving us some very important concepts. Investing in mutual funds, really 101. Thank you so much.
Thank you for having me. Always a pleasure.
All right, with that, we're out of time. But remember, this is your show. Keep sending us your feedback, comments, queries, other issues you want us to discuss, and we'll keep getting them to you. Thank you very much for watching. See you again next week.
Let's talk money.